Good morning, class, students, and everyone. This is your faculty and coach for the subject Business Environment, Vivek Birda from Tirthanka Mahavir University. As a faculty, I had taken up as a faculty and coach and a mentor for the subject. I had taken up large number of topics, and we are almost about the end of this course. In next 5-6 sessions, we are going to wind up our content, and also will be going to end up with our syllabus also. We had so far covered almost major contents. We are now on the other side of the topic that represents the global environment for the businesses, in which we had seen in our last session about the role of the GATT, WTO, and we have carefully and clearly understood about the UR agreement, about the Doha agreement, about the Bali package, about the role of the WTO for the developed and the developing nations, and the role of WTO for the India. So this is for what was taken up in our last session. Today we are moving ahead into the impact of the global environment, where we will be studying about first topic we are going to take up is the international investments. So international investment is our new topic which we are going to cover up over here. In the international investments, we will be studying following subtopics. We will study about the type of foreign investment, the significance of the foreign investment, limitations and dangers of the foreign capital, the factors affecting international investment, the growth of the FDI, directional trends, sectoral trends, cross-border mergers and acquisitions, foreign investment in India, and the foreign investment by the Indian companies. So moving ahead in this part, the first part represents the economic liberalization that swept across the world, particularly since the late 1980s, have very significantly changed the environment for the international investments. At the same time, surging the international capital flows in its turn are substantially impacting the business environment. As Peter Duckner in his Managing for the Further observes, increasingly world investment rather than the world trade will be driving the international economy, and the exchange rate, taxes, and the legal rules will become more important than the wage rate and the tariffs. Thus, in this, the type of the foreign investments which goes. Broadly, there are two types of foreign investment. First is the FDI, that is foreign direct investment, and the second is the portfolio investments. The foreign direct investment refers to the investment in the foreign country where the investor retains control over the investment. In this, it typically takes the form of the starting a subsidiary, acquiring a stake in the existing firms, or starting a joint venture in the foreign country. The direct investment and the management of the firms concerned normally to go together. If the investor has only a sort of property interest in investing the capital in buying the equities, bonds, or other security abroad, it is referred to as a portfolio investment. That is, it is the case of the portfolio investments, and the investors use his capital in order to get a return on it, but has no much control over the use of the capital. Thus, the FDIs are governed by the long-term cap considerations because these investments cannot be easily liquidated. Hence, factors like the long-term political stability, government policies, industrial and economic prospects, etc., influence the FDI decisions. However, the portfolio investments which can be liquidated fairly easily are influenced by the short-term gains. Portfolio investments are generally much more sensitive than the FDIs. The direct investors have direct responsibility with the promotion and the management of the enterprise. The portfolio investors do not have such direct involvement in the promotion and the management. Since the economic liberalization of 1991, there have been a surge in the FDIs and the portfolios investment in India. There are mainly two routes of portfolio investment in India. The first is foreign institutional investors, that is FIIs, like the mutual funds, and through the global depository receipts GDRs, American depository receipts ADRs, and the foreign currency convertible bonds FCCBs. The GDRs, ADRs, and the FCCBs are instruments issued by the Indian companies in the foreign market for mobilizing foreign capital by facilitating portfolio investment by foreigners in Indian securities. Since 1992, Indian companies satisfying certain conditions are allowed to access the foreign capital market by the euro issues. With reference to the foreign investment in India, the foreign investment can be classified as below. That the foreign investment goes through two ways. The first is direct investment, and the second is the portfolio investment. In the direct investment, the investment comes either through the wholly owned subsidiary or through the joint venture or by the acquisitions. But when we talk for the portfolio investments, it is either direct investment by the FIAs, that is foreign institutional investors, or by the investment in the GDRs, FDRs, FCCBs, etc. Next is the significance of the foreign investment. The foreign capital and the technology can play a very important role in the socio-economic development of the nation. they are very significantly contributed to the development of the developed countries, and the foreign capital and the technology has been playing a significant role in the development of the number of the developing countries. A classic example is China. One of the ways by which the foreign capital helps to accelerate the pace of the economic growth is by facilitating essential imports required for carrying out the development programs. Like capital goods, know-how, raw materials, and the other inputs, and even the consumer goods. Thus, the machinery, know-how, and the other inputs needed may not be indigenously available. Further, the demand spread created by the large investments may necessitate the import of the consumer goods. When the export earnings are insufficient to finance such vital imports, the foreign capitals could reduce the foreign exchange gaps. Thus, the foreign investments may also help increase a country exports and reduce the import requirements in such investments which take place in the export oriented and the import competing industries. In the early years of the present decade, nearly half of the Chinese exports, that which is absolute term, was about three times the total exports of the India, and was said to be the contribution of the foreign funded enterprises. Following the analysis of the Donald McDougall and the Paul Stern, Gerald Meyer observes that from the standpoint of the national economic benefit, the essence of the case of encouraging an inflow of the capital is that the increase in the real income resulting from the act of the investment is greater than the resultant increase in the income of the investors. If the value added to the output by the foreign capital is greater than the amount appropriated by the investors, the social returns exceeded the private returns. Thus, as long as the foreign investment raises the productivity and this increase is not wholly appropriated by the investors, the great product must be shared with others, and there must be some direct benefits to the other income groups as mentioned below. The first is the domestic labor. The domestic labor must get higher real wages because of the increase in the productivity. This might also be the expansion of the employment opportunities. The second is the consumer. In the foreign investment is the cost reducing in a particular industry. The consumer of the product may gain through the lower product prices if the investment is product improving or product innovating, or the consumer benefits from the better quality products or the newer products. Third is the government. The increase in the production and the foreign trade resulting from the foreign capital might increase the fiscal revenue of the government. Fourth is the external economies. The foreign capital may bring in number of the indirect gains through the realization of the external economies. For instance, if foreign investment is used for the development of the infrastructure, it could stimulate domestic investments in the industrial and the other sectors. In the endogenous growth framework, the source of the growth attributed to the capital flows comprises of the spillovers associated with the foreign capital in the form of the technology, the skills, and the introduction of the new products, as well as the positive externalities in the terms of the higher efficiency of the domestic financial markets, improved resource allocations, and the efficient financial intermediation by the domestic financial institutions. Further advantages of the foreign capital are mentioned under the private foreign capital below. As indicated in the opening paragraph, the foreign investment is playing an increasing role in the economic development, and the changes in the composition of the capital flows and the substantial increase in the magnitude of some of the flows like FDIs have remarkably changed the balance of the payments and the foreign exchange reserves positions of the several countries. The debt creating flows as a percentage of the total flow in the BOP of the India averaged as much as 97% during the seventh plan, that is 1985 to 90, but declined to less than 20% by the mid-90s. Eventually, India began to experience a surplus of BOP and a very remarkable improvement in the reserve positions. Thus, the foreign investments has assisted and is assisting the economic growth of many countries. As the World Bank reports points out, for the developing countries, the FDI has also falling advantages over the official development assistance (ODA). The FDI shifts the burden of the risk of the investment from the domestic to the foreign investors. Repayments are linked to the profitability of the underlying investments, whereas by under the debt financing, the borrowed funds must be serviced regardless of the project cost. Third, further, it has also been observed that the FDI is the only capital inflow that has been strongly associated with the higher GDP growth since 1970s. The contribution of the FDIs to the economic growth is highlighted by the fact that the ratio of the FDIs flow to the domestic investment, that is the gross capital formation, rose for most developed and the developing countries in the past. Although the bulk of the FDIs goes to the developed countries, it is its share in their gross fixed capital formation GFCF is only about half of that is the developing countries because of the massiveness of their GFCF. Apart from the potential gains through the technology transfer, the FDI has generated the large employment opportunities in the number of the countries. And given the limitation of the domestic saving, many developing countries will have to rely on the foreign investments to accelerate the economic growth. It may be noted that China, which has been able to maintain a high GDP growth rate for the long time because of the high saving rates and the huge inflows of the FDIs, thus addressing a session on the infrastructure, quite a seminar on the moving to the market, sustaining the reforms in the India and the Asia, organized by the Confederation of Indian Industry (CIA) and the Asian Society in New Delhi on 9th March 1997. Gordon Wu was observed that the foreign investment brings the 4 E's, that is efficiency, equity, experience and the expertise. I'm repeating, the foreign investment brings 4 E's, that is efficiency, equity, experience and expertise, in which in return there is a 5th E, that is the expectation of the profits. That means the investors expect the profits against their investments. Now the foreign private investment, the foreign capital mostly takes the form of the direct investments. Hence we deal here with the direct foreign investment, that is the private investment. The most advantage of the foreign direct investments are as follows. First, it helps to increase the investment level and thereby the income and the employment in the host country. Second, the foreign investment may increase the tax revenue of the government. Third, the direct foreign investment facilitates the transfer of the technology to the recipient countries. Fourth, it may kindle the managerial revolution in the recipient's country through the professional management and the employment of the highly sophisticated management techniques. Fifth, the foreign capital may enable the country to increase its export and reduce the imports requirements. Sixth, the foreign investments may stimulate the domestic expertise because of the support of their own operations, and the foreign investors may encourage and assist the domestic suppliers and the consuming industries. 7, the foreign investments may also help increase the competition and break domestic monopolies. If the foreign investment improves the quality and reduce the cost of the inputs, that would benefit the domestic industry. Limitations and the dangers of the foreign capital. The foreign capital, both private and the official government and institutional, have certain limitations. Certain additional risks are associated with the private foreign capital. One of the most important limitations to utilize the foreign capital is the absorptive capacity of the recipient country, that is the capacity of the country to utilize the foreign capital effectively. The lack of infrastructural facilities, the technical know-how, personal inputs, market feasible projects, inefficiency or inadequacy of the administrative machinery, etc., which are important factors that affect the absorptive capacity. Sometimes the strings are attached to the official assistance and the recipient country, which may be persuaded to fall in line of the ideology or the direction of the donor. The following criticisms are leveled against the foreign capital. First, the private foreign capital tends to flow to the high profits areas rather than to the priority sectors. Second, the technology brought in by the foreign investors may not be adapted to the consumption needs, size of the domestic market, resource availability, stages of the development of the economy, etc. Third, through their power and flexibility, the multinational corporations may evade to the undermine economic autonomy and the control, and their activities may be inimical to the national interest of the particular countries. Fourth, the foreign investments sometimes have unfavorable effect on the balance of payments of the country because of the drain of the foreign exchange by way of the royalty, dividend, etc., and is more than the investment made by the foreign concerns. Fifth, the foreign capital sometimes interferes in the national politics. And sixth, the foreign investors sometimes engage in the unfair and the unethical trade practices. Sometimes the foreign investments can result in the dangerous situation of minimizing, eliminating competition and creation of the monopolies of the oligopolistic structures. Eighth, the FDIs also potentially displace the domestic producers by preempting their investment opportunities. Ninth, often several costs are associated and encouraging foreign investments. Mere observers that the cost may arise from the special concessions offered by the host country and the adverse effect on the domestic savings, deterioration in the terms of the trade, problems of the balance of the payments and the adjustments. Next is the factors which affect the international investments. The theories of the foreign investment described above has indicated as several possible reasons for the foreign investments. This section is further extension to the important factors which affect the international investments. First is the rate of interest. One of the most important stimuli to the international capital movements is the difference in the rate of the interest prevailing at the different places. Capital has a tendency to move from country with the low rate of interest to the country where it is higher, and other being equal interest rates or the foreign exchange rates. Second is speculation. The short-term capital movements may be influenced also by the speculation pertaining to the anticipated changes in the interest rates on the foreign exchange rates. Third is the profitability. The private foreign capital movement is influenced by the profit motives. Hence, other things being equal, the private capital will be attracted to the countries where the returns of the investment is comparatively higher. Fourth is the cost of production. Private capital movements are encouraged by the lower cost of production in the foreign countries. As Karen points out, that we may distinguish between the two types of cost reducing investment. The first arises from the need to obtain the raw material from the abroad. Such materials may be either unavailable at the home or obtainable only at the extremely high cost, but they are essential for the production and the sales of the final products at the home or abroad. Without them, the profit opportunities would remain unexploited. Indeed, vast investments in the extractive industries are motivated by the fact that the capital must go where the resources are. And the second type of the cost reducing investment pertains to the cost of the commodities other than the materials, primarily the labor. Fifth is the economic conditions. The economic conditions, particularly the market potential and the infrastructure facilities, influence the private foreign investments. The size of the population and the income level of the country have an important bearing on the market opportunities. Six is the government policies. The government policies, particularly towards the foreign investments, foreign collaborations, remittance, profit taxation, foreign exchange control, tariffs, and the monetary, fiscal, and other incentives are important factors that may influence the foreign investments in the country. Seventh is the political factors. The political factors like the political stability, nature of the political parties, and the relation with other countries are also influence the capital movements. Thus, the host country's economic determinants. Traditionally, the economic determinants of the inward FDIs have been grouped or analytically convinced into the three clusters, each of them reflecting the principal motivations of investing in the foreign countries, that is the resource seeking, market seeking, and the efficiency seeking. Resources. Historically, the most important motivation of the FDIs have been in the exploitation of the natural resources. Dunning points out that in the 19th century, much of the FDIs by the European, United States, and the Japanese firms were promoted by the need of the secure and the economic and reliable source of the minerals, primarily products of the investing and industrializing nations of the Europe and the North America. Up to the eve of the Second World War, and about 60% of the world stock of the FDIs was in the natural resource. And the post-war period, particularly since 1960s and 1970s, witnessed a decline in the share of the natural resource in FDIs. Besides the decline in the importance of the primary sector in the world output, this decline was caused by the factors such as development of the indigenous enterprises in the sector. In the number of the developing economies, the public sector comes to play with an important role in the resources-based industries. The public sector efforts also included the equity or the technical collaborations with the MNCs. Although the share of the primary sector in the FDIs has declined, there has been a substantial increase in the FDI in the sector in the absolute terms. Thus, the host country determinants of the FDIs. The host country determinants, the first is the policy framework for the FDI. That means it focuses on the economic, political, and the social stability, the rules regarding entry and the operations, the standard of treatment of the foreign affiliates, the policies of functioning and structure of the markets, especially competition and the mergers and acquisition policies, international agreements on FDI's privatization, the trade policies with respect to the tariffs and the NTBs, and coherence of the FDIs and the trade policies. And the last is the tax policy. Second is the economic determinants, and the third is the business facilitation. The investment promotion, including the image building and the investment generation activities and the investment facilitation services. Second is the investment incentives. Third is the hassle cost, that is related to the corruption, administrative efficiency, etc. Next is about the social amenities, which include the bilingual schools, quality of the life, etc. after investment services. Thus, the type of the FDIs are classified with the motives of the TNCs. There is the principal economic determinants in the host countries. First is the market seeking. The market seeking represents the following principal economic determinants. First is the market size and the per capita income. Second is the market growth. Third is the access to the regional and the global market. Fourth is the country-specific consumer preferences. Fifth is the structure of the market. Next is about the resources and the asset seeking, in which the first is the raw material, second is the low-cost unskilled labor, third is the skilled labor, fourth is the technological innovatory and the other created assets, which include the brand names, including as embodied in the individual firms and the clusters. Next include the physical infrastructure, ports, road, power, telecommunication, etc. Thus, in third includes the efficiency seeking, the cost of the resources and the asset listed under B adjusted for the productivity for the labor resources. The other input cost includes the transport and the communication cost to and from or within the host economy and the cost of other intermediate products. The membership of the regional integration agreement conducive to the establishment of the regional corporate networks. Into the international investment, the next topic is the market. Another important traditional determinants of the FDIs have been the market seeking. The market is protected for the international competition by the high tariffs or the quota triggered tariff jumping FDIs. Union point out that the market access become predeterminant motive for investing in the manufacturing sector for the developed countries between the two world wars and for the developing countries in the 1960s and 70s. During the heyday to the import substitution and industrialization, this motive was paramount. For example, in the wave of the United States investment in the Europe, especially in the United Kingdom during the early post-war period, and in the Japanese investment in the United States after mid-90s, following voluntary export restrictions and the possibility of the further protectionist measures in the automobile industry. The lion's share of the FDI flows of the developing countries goes to the large market with comparatively good infrastructure and the political stability in general. The growing importance of the service sector has also been resulting in the increase in the FDIs because of the fact that most services are not tradable, and therefore the only way to deliver them to the foreign market is through establishment abroad. However, the highly regulated nature of the service sector has been a deterrent to the FDI's flows in its full potential. The efficiency, another important motivation of the FDI is efficiency seeking. Low cost of the production, driving most of its cheap labor, is the driving force of many FDIs in the developing countries. The export processing zones have been developed by the developing countries almostly to take the advantage of the efficiency seeking FDI's flows. It may be noted that the presence of any of these three determinants mentioned above alone need not to attract the FDIs. For example, even if a country has a natural resource or abundance of the cheap labor, FDIs would not take place in absence of the required infrastructural facilities to develop the industry or the trade. Besides, several other factors like the political, environmental, government policies, bureaucratic culture, social, climatic, etc., are also important determinants of the FDIs. Next is about the growth of the FDI. Following the sweeping changes in the economic policies, the foreign investments have been surging in many countries. Today, the worldwide FDI's flows in the stocks are about 20 times their size in the early 1980s. The trend in the magnitude of the flow, although the foreign direct investment flows have been upward, up and down, thus the long-term trend it has been one of the fast growth. For example, between 1970 to 2000, the FDI's inflows worldwide increased more than 100 times. The growth has been the sharpest between 1990 and 2000, which then, thanks to the universal liberalization, privatization, and surge in the cross-border mergers and acquisitions by these developments. It was estimated that in the years that around $1461 billion in 2013. After peaking in 2000, the FDI flow had a downturn. The upward trend in the inflows began again in 2004, and the FDI's inflows peaked in 2007. Thus, $2100 billion was lower in the subsequent years. While the FDI flows had their up and downs, the stock of the FDI has increased tremendously over the time. There was the worldwide FDI inward stock increased from 1779 billion US dollars in 1990 to 5810 billion US dollars in 2000, and further to 1199 billion dollars in 2006. The FDI inward stock as percentage of the GDP increased more than 4 times between 1990 to 2013. From 8.4% to 34.3%. For developing economies, the figure were 9.6 to 31.1%. The cyclical behavior. The FDI's flows are characterized by the cyclical behavior. Thus, the decline in the FDI flows after peaking in 2000 followed the rapid increase during the late 1990s as a world Investment Reports points out that there was similar pattern during the late 1980s and early 1990s and in 1982-83. Thus, it was the third downward cycle in FDIs, each punctuating a long upward trend in the FDIs even 10 years or so. Factor affecting the trends in the FDIs. The swing in the FDIs flows reflect the change in the several factors. The main one are the business cycle, stock market sentiments, and mergers and acquisitions. And these short-term factors, which include the factors such as terrorist attack of the September 11, 2000, work in tandem and with the long-term factors sometimes offsetting and the short other terms reinforcing them. There is, on the other hand, a stable and a positive relationship between the global FDI flows and the level of the growth on the world GDPs. Technological change, shrinking economic distances, and the new management methods which favor the international production. Their impact is, however, countered by the cyclical fluctuations in income and growth. The decline in the FDIs in 2001 reflected a slowdown in the world economy. More than a dozen countries, including the world three largest economies, fell into the recession. On the supply side, FDI is affected by the availability of the investment funds from the corporate profits or the loans, which is in turn affected by the domestic economic conditions. On the demand side, the growing overseas market led TNCs to invest while depressed markets in exhibit them. The more interdependent host and home economies become, and the more widely a recession or upswinging spreads, the greater are the corresponding movements in the global FDIs. Thus, the data for 1980-2001 show that the bulge in the global FDIs accompanies high economic growth and tough accompanies low growth. However, the relationship between the GDP growth and the FDIs is not uniform across group of the economies. They go together in developed but not in the developing countries. One explanation for the different patterns of the FDI flow is that the business cycles spread much faster across developed countries than others. A supplementary explanation that may have been for some other countries as the CEE had been cut off from the substantial FDI flows for so long that they have been a lot of catching up to do, and the short-term cycles do not affect their attractiveness. Thus, the rise in the global FDI's flows in 2006 was partially driven by the increasing corporate profits worldwide and resulting in the high stock prices that raised the value of the cross-border mergers and acquisitions. Thus, the mergers and acquisitions continue to account for the high share of the FDI flows, but the greenfield investments also increased, especially in developing transition economies. As a result of the higher corporate profits and reinvested earnings, which has become an important component for the inward FDIs, they've accounted for the estimated 30% of the total inflows worldwide in 2006 and for almost 50% in the developing countries alone. One of the important determinants of the FDI's determinant in the trend is the cross-border mergers and acquisitions. For example, the dramatic increase in the cross-border mergers and acquisitions led to the record flows in 1999 and 2000, and the cross-border merger and acquisitions made its contribution to the decline in the FDIs too. Next is the directional trends. The major chunk in the FDIs flow that take place between the developed countries for nearly 3 decades till the early 1990s, about 3/4 of the FDIs has gone to the developed countries. Nearly 2/3 of the flows have taken place in the countries of the Triad, that is the US, European Union, and the Japan. The share of the developed countries in the FDI inflows and the outflows declined in the recent years. The FDIs is concentrated in the handful of the countries. About the dozen countries receive nearly 3/4 of the global FDI flows. A high degree of the concentration is observed in the respect to the FDI flows to the developing world. In 2014, for example, China and the Hong Kong alone received about 32% of the inflows of the developing economies. More importantly, there are no signs that the concentration of the international production across the countries have been declining over the time. However, in many least developed countries that they only receive only small amount of the FDIs, and such investment is important vis-a-vis the size of the domestic investment. What remain the challenge for these countries is the ability to attract not only more but also the higher quality FDIs. The largest recipient of the FDIs has either been the UK or the US. The US has been the largest foreign investor too. France has been the largest foreign investor. The France has been one of the largest foreign investors, while the UK has also been experiencing the large outflow. So this particular table shows the share of the percentage of the developing countries in the FDIs which are fluctuating. We can see that the developed economies in 2011 to 2014 there is a shift in the FDIs. Same is for the developing economies. While the developing economies we can see the rise, in the developed we can see the decline and then again the rise. But for the transition economies there is a very minimum investments over there. Similarly, the FDI outflows can also be seen for the developing and for the transition economies. Next is the investment pattern. The investment pattern of the examination of the investment pattern. And this is the major source of the FDI, which shows that there is generally a regional bias in the investment in the developing countries. Thus, the US investment was largely in the Latin America. The Japanese investments went mostly to the Asian neighbors, and so on. For instance, the investment by the UK and the German firms have been mainly in the manufacturing, while the US and the Japanese investment, although had been evenly spread over the major economic sectors and the bias towards the manufacturing and the primary industries. Within the manufacturing sectors, and the major economic sectors have been biased towards the manufacturing and the primary industries within the manufacturing sector, which are being directed. Within the manufacturing, which includes the electronics. Thus, the vast expansion of the investment opportunities across the world should be expected to encourage some changes in the direction pattern of the foreign investment inflows. That the important trends in the FDIs inflows to the direct developing countries. The share of the FDIs going to the developing countries declined substantially from 25% during 1980-85 to 17% during 1986-90. Thereby, there was, however, an increase in the absolute of the FDI's inflows of the developing countries and the economic liberalization. The economic liberalization in the developing countries have helped to increase the FDIs of them. During 2003 to 2006, the share of the developing countries in the global FDI inflow ranged from 26% and 39%. In the recent years, their share was more than half of the total. In 2014, the 10 developing countries were among the top 20. They were among the top 20 of the top 20 recipients of the FDI compared to the 7% in the 2009. Even while the level of the FDIs, inflow of the developing countries rise, the fluctuations of the FDI flow of the developed economies affect the share of the developing countries. FDI in the developing countries have been larger than the official inflows of even every year. since 1993, and it was 10 times larger than the bilateral official development assistance ODA in 2000. And this contrasts with the greater half of the 1980s when the two were about equal. Recently, also FDIs have accounted for about 90% of the total financial inflows of the developing countries. Within the group of the developing countries, the relatively developed among them get the lion's share of the FDIs. Very little FDIs have taken place in the low income economies, leaving the exception like China and India. In most cases, it has been due to the small size of the domestic market and the other adverse factors like the poor infrastructure, lack of the skilled laborers, etc. Thus, the lion's share of the FDI flows of the developing countries have been concerned by the two regions, that is the East Asia, the Pacific, and the Latin America, while the Sub-Saharan African, Middle East, and North Africa got a very low share. Thus, the least developed countries, like numbering 48, get the very insignificant share. One transitional attraction of the foreign investment with the cheap labor is becoming very less important. Foreign investment today is not mainly to the exploitation of the local resources. The foreign companies today evaluate the market potential, production, and the related facilities and their efficiencies inter alia for the investment decision making. Thus, the countries with the large and the growing market, fairly developed infrastructure, and the efficient input supplies, conducive trade policies, favorable political environment, required type of the manpower supplies, etc., rank high for the investment. And encouraging government policies alone is not sufficient. China has been able to attract the huge FDIs because of its economic growth for the quite some time now, which has been very good. It is one of the largest potential market in the world because of the status policy of the until recently it is virtually a virgin market for many products. Where the labor force is disciplined by the state and the China has favorable political and the bureaucratic environment. Although India is not as attractive as China in terms of the above factors, its potential is enormous. FDI flows to the India have, however, been discouraged by such factors as confusing political environment as reflected by the Iran controversy, agitation against second multinationals, and the bureaucratic problems. Next is about the outward FDIs from the developing countries. The FDIs outflow from the developing economies have been significantly increasingly reflecting this recognition of the firms and the globalizing world economy. They need a portfolio of the localization assets to be competitive internationally. In fact, many countries like Malaysia, the Republic of the Korea, and the Singapore already have established a track record, and some others such as Chile, Mexico, South Africa has played and become the players relatively recently. Countries like Brazil, China, and India are at the takeoff stage. Their investment spans all sectors and country groups and involve the complex as well as the simple industries. Thus, the annual FDIs outflows from the developing countries have grown very faster since the every very faster. Thus, the outward FDIs from the developing countries increased from about 16% to the total population to the world total in 2007 to 39% in 2014. In 2014, 9 of the top 20 international investors were developing countries compared to the 6 in 2013. Thus, the FDI flows from the developing countries seems to be growing faster than from developing countries to the developed countries. Thus, the growing importance of the South-South FDIs indicates that the developing countries are more financially integrated with one another than the previously believed, and thus the typical developing countries have access to more sources of investment than before. It is particularly important for small economies such as TNCs from the south because of their comparatively advantages, which tend to invest in the countries with the similar or the lower trends of the development than their home countries. Next is about the sectoral trends. All the FDIs have grown over time of all the three economies, that the primary manufacturing and the services, and the sectoral composition has undergone the significant changes with the market shift towards the services. The primary sector share in the world FDI stock was less than 10% in 1990 and 2006. However, in the case of FDI flows between 1989 to 1991 and 2001 to 2002, the share of the primary sector does not decline. It rose from 7% to 9%, while nearly all FDIs in the sector continues to originate from the developed countries. Developing countries may be In the developing countries, many of them rich in the natural resources but lacking internationally competitive national firms, and which attract to the considerable FDIs. Thus, the 32% of the total primary sector FDI in 2002 within the primary sector, the minimum varying in the petroleum dominance, the primary sector FDIs with over 20% of the FDI stock. During 2003 to 2006, the primary sector accounted for 13% of the FDI inflows and up to 7.5% during 1989-91, and it was 40% in 2011. The manufacturing sector, the share of the manufacturing in the global FDI stock worldwide fell from 42% in 1990 to 30% in 2005, and the manufacturing FDI is increasingly geared to more capital and the knowledge intensive and the activities because of the two developments. There have been a decline in about the intensive manufacturing in general and the share of the traditional manufacturing employment which have steadily declined. Thus, the technological changes which are leading to the increasingly replacement of the labor by the capital and the knowledge, which has been a key element in the decline of the labor-intensive FDIs in the manufacturing. Secondly, the firm is more and more, the firm in more and more countries, specifically developing countries, have developed their own ownership specific advantages based on the different factors, endowments, and particularly the low-cost labor vis-a-vis developed countries. Its share in the global FDI's inflows, which fell from 37% during 1989-91 to 25 during 2003-5, and it was 46% in the 2011. The service sectors during the period 1990 to 2002, while the global FDI stocks in the primary sector nearly doubled, and in the manufacturing sector it increased nearly threefold. In the service sector, it is more than quadrupled as a result of more rapid growth in the sector than in the other sectors. The services accounted for about two-thirds of the global stock of the inward FDIs in 2005, compared to less than one half in 1990 and only one quarter in the early 1970s. It was 40% in 2011. Services continue to receive the lion's share of the FDIs. The cross-border mergers and acquisitions. The cross-border mergers and acquisitions have been a key driver for the global FDI since the late 1980s. And a very significant aspect of the recent FDI surge is that it is triggered to a large extent to the cross-border mergers and acquisitions. For instance, the total value of the cross-border of the mergers and acquisitions with the value of over 1 billion each alone accounted for three-fourths of the value of the total FDI flows in 2000. During 2004-6, the share of the cross-border mergers and acquisitions in the global FDI flows ranged between 54 and 78%. Thus, the cross-border mergers and the acquisitions, that is, M&A, involves FDIs in the host country by merging with or acquiring the existing local firm. In the latter case, the acquisition involves an equity stake of 10% or more. The share of the FDI accounted for by the cross-border mergers and acquisition and is difficult to determine since data sets are not directly comparable. First, the value of the cross-border mergers and acquisitions include the funds raised in the local and the international financial markets. Second, the FDI data are reported on the net basis using the balance of the payments concepts, while data on the cross-border mergers and acquisitions purchases or the sales reports only the total value of the transactions. Finally, the payment of all the cross-border mergers and acquisitions are not necessarily made in the single year, but are may be spread over the longer period. As an UN reports points out, one recent feature is that the mergers and acquisitions among the large or the dominant TNCs resulting in the even larger TNCs seems to impel other major TNCs to move towards restructuring or making similar deals with other TNCs. Thus, the pharmaceutical, automobile, telecommunication, and the financial industries are typical examples of the industries in which such concentration can be observed. This trend significantly changes the industry structure. In the automobile industry, for example, the total number of the major automobile makers, which may well decline to 50 to 10 by 2010 from the 1998 figure for 15. In the pharmaceutical industry, many markets are now controlled by the small number of the firms. In both these industries, there have been a string of mergers and acquisitions. The major merger and acquisitions in the pharmaceutical include the GlaxoSmith, Pfizer's, Warner, Lambert, and others. Thus, the trend towards merger and acquisition is also accelerating. The sale of the non-core operations or the affiliates of the firms and the acquisitions of the similar operations and other firms of the divisions of the or affiliate or the firms which have a similar business. This indicates the strategic shift of the TNCs to focus of their core activities, unlike in 1980s There were fewer deals among unrelated. In addition to the strategic consideration of the firms, the liberalization and the deregulations are also other major factors which are behind the dramatic increase in the mergers and acquisitions. An increase in both the developed and the developing countries. Thus, the developed countries accounted for the lion's share of the mergers, which nearly 90% of the total. However, an upward trend in the mergers and acquisition sales by developing countries and the countries in the transition is noticeable. Among developing countries, the majority merger and acquisition sales in the South, East, and Southeast Asia have increasingly recently, in the particular after 1997 financial crisis. In Latin America, Central and East Europe have also recorded a significant increase in mergers and acquisition sales. There has been a substantial shift towards the services in the cross-border mergers and acquisitions, and it has become a widely used mode of TNC entry in such services industries as banking, telecommunications, and the water. While in the late 1980s, services accounted for less than 40% of the global cross-border. Thus, the foreign investments in India, the flow of the foreign investments in India have been comparatively limited because of the type of the industrial development strategies and very cautious foreign investment policy which are followed by the nation. The direct foreign investments in India are adversely affected by the following factors. The public sector are assigned a monopoly or dominant positions in most important industries, and therefore the scope of the private investments, both domestic and the foreign, was limited. When the public sector enterprises needed foreign investments or investment, there was a market preference for the foreign government resources. The government policy towards the foreign capital was very selective. The foreign investment was normally permitted only in the high technology industries in priority areas and the low and the export oriented industries. Thus, the foreign equity participation was normally subjected to the ceiling or 40%, although exceptions were allowed on the merit. Thus, the payment of the dividends abroad, repatriation of the capital, etc., as well as the inward remittances were subject to the stringent laws like Foreign Exchange Regulation Act (FARA). This discouraged the foreign investments. The corporate taxation was high and the taxes law procedures were complex, and the factors either limited or the scope of the discouraged the foreign investments in India. Next is about the government policies. The following paragraph give you a very brief about the government of India's policy towards the foreign capital and the technology. First, the salient features of the policy towards still economic liberalization introduced in the July 1999 was given, which are followed by an account of the new policy. India was following a very restrictive policy towards the foreign capital and the technology. The foreign collaborations were permitted only in the fields of the high priority and in the areas where the import of the foreign technology was considered necessary. In other areas, the import of the technology was considered on the merit if substantial export was guaranteed over the period of 5 to 10 years and if there were reasonable proposals for such exports. The government has issued list of industries which were first the foreign investments which may be permitted, second the only foreign technical collaboration that but no foreign investments may be permitted. Third, no foreign collaboration, financial or technical, was considered necessary. Thus, the government policies on the foreign equity participation was thus selective. Such participation may be justified with regard to the factors such as nature of the technology involved, whether it would promote the exports, which might not otherwise take place, and the alternative terms available for securing the same or similar technological transfers. Thus, the foreign equity participation was limited to 40%. All the exceptions were allowed to merit. The foreign share capital was to be by way of the cash without being linked to the tied imports of the machineries, equipments, or to the payout to know-how, trademarks, brand names, etc. The technical collaborations were to be considered on the basis of the annual royalty payments, which were linked with the value of the actual productions. The percentage of the royalty was dependent on the nature of the technology. Whenever possible, the payment of the fixed amount or the royalty per unit of the production was preferred. The royalty payments were limited to the period of 5 years. The Foreign Exchange Regulation Act (FARA) 1973 served as a tool of implementing the national policy on the foreign exchange, foreign private investments in India. The FARA empowered the Reserve Bank of India to regulate or exercise the direct control over the activities of the foreign companies and the foreign nationals in India. A foreign company was defined as other than banking company which may not incorporated in India or in which no resident interest was more than 40% of any other branch for such company. According to FERA, the non-residents, including the Indian citizens, foreign citizens, residents in India, and the foreign companies, required the permission of RBI to accept the appointment as the agent of the technical management advisors in India or for any persons or company and which permit the use of their trademarks. Thus, the trading, commercial, and industrial activities in India. Student, just wait for a minute. There is something urgent. I need to handle that query also. I'm sorry for that part. Yeah. So, according to the FERA, the non-resident, including the Indian citizens, the permission to accept and RBI to accept the appointment as the agents of the technical management advisors in India or any other persons of the company to permit the use of their trademark. The trading, commercial, and the industrial activities in India of the person residents abroad, the foreign citizens in India, and the foreign companies which are regulated by the FERA. They too had to obtain the permission from the RBI for carrying or in the India any activities of the trading, commercial, and the industrial natures, opening branches, offices, or other places of the businesses in India, acquiring any business undertakings in India, and purchasing the shares of the Indian companies. Thus, the RBI had given a general permission for certain matters. For example, the general permission was granted to the foreign companies to acquire and hold any immovable property in India, which was then necessary for the incidental to any activity which were undertaken by them with the permission of the RBI. Lastly, over here is the policies, which was been discussed earlier also. Then about the FII investment. The FII investment, the Indian stock market was opened up to the FII investment in 1992-93, and since then there has been a significant increase in the portfolio investments by the art. According to the mutual funds, according to the IMF, the definition of portfolio investment refers to the cross-border transactions and the positions involving the debt of the equities, securities other than those included in the direct investments of the reserve assets. In India, the FII covers overseas pension funds, mutual funds, investment trust, asset management companies, nominees company, banks, institutional portfolio managers, university funds, endowments, foundations, charitable trusts, charitable societies, trustees of the power of attorneys, holders incorporated or established outside India, proposing to make the proprietary investments or investments on behalf of the broad-based funds. That is the fund which have more than 20 investors with no single investor holding more than 10% of the shares of the units in the fund. And India is one of the major largest recipient of the portfolio inflows among the emerging market economies. Next is the regulation of the foreign institutional investors, which are notified on November 14, 1995, which contains various provisions relating to the definition of FIIs, eligibility criteria, investment restrictions, procedures of the restriction, and the general obligation and the responsibilities of FIIs. According to the regulation, FIIs may invest only in first securities in the primary and the secondary market, including the share, debentures, and the warrants of the companies which are listed on the recognized stock market in India. The unit of the schemes floated by the domestic mutual funds, including of the unit trust, whether listed on a recognized stock exchange or not. Third is about the joint ventures between the variety of the domestic and the foreign securities. The firms have been approved in the stock broking and the merchant banking, asset management, and other non-banking financial services sectors. The overall effect of the FI investment and the financial joint ventures have been in the introduction of the international practices and system of the Indian securities market. FIs are permitted to invest in the company up to the aggregate of 24% of the equity, which can be increased to 40% subject to the approval of the board of directors and the special resolution to the general body. In 1996-97, the government liberalized the FI's investment policies, allowing them to invest in the unlisted companies and the corporate government securities. Thus, the FI's investment have become a very important determinant of the stock market trends in India. FDI's inflows as a percentage of the gross national capital formation of India increased from less than 2% during 1990 to 2006 to nearly 6% in 7, but less than 5% in 2003. Then about the euro and the ADRs. As mentioned earlier, since 1992 to 1993, the early companies satisfying certain conditions are allowed to access the foreign capital market by the euro issues of the capital domestic recipient GDRs and the foreign currency convertible bonds FCD-CBs. A depository receipt is basically a negotiable certificate denominated in the US dollars, then which represents the non-US company publicly traded local currency, and the Indian rupee equity shares DRs, which are created when the local currency shares of the Indian companies, for example, are delivered to the depository local custodian bank against the depository bank, such as Bank of New York, which issues the DRs in the US dollars, and the depository receipts, which may trade freely in the overseas market like any other dollar denominated security, either on the foreign stock exchange or over the counter market, or among the restricted group may be qualified institutional buyers. Thus, the prefix global implies that the areas are marketed globally rather than the specific country or the market. Thus, the companies with the global track record and with the 3 years may avail euro issues for the approved purposes. According to the revised guidelines issued in November 1995, companies investing in the infrastructure projects, including the power, petroleum exploration and refining, telecommunications, ports, roads and airports, are exempted from the condition of the 3 year track record, and is expected to help the companies in the infrastructure sectors to access the cheap infrastructure funds. Earlier, the companies had capped these funds raised through euro issues in foreign currencies, which deposited in the banks and the public financial institutions in India to be converted into the Indian rupees, and as when required for the expenditure or the approved, which end up use of 25% of the euro issue, which are proceeding for meeting the corporate restriction of the working capital requirements. Then is about the mergers and acquisitions. The mergers and acquisition in the liberalization, privatization, delicensing, liberalization of the foreign investment policies, scrapping of the MRTPs, restrictions on the merger and acquisition, and the CB takeover code has opened the door for the cross-border mergers and acquisitions in India. The foreign MNCs have been using mergers and acquisitions as a market entry strategy and the competitive strategy, whereas several MNCs have acquired a partner stake in the joint venture and also have held the stake in the joint ventures and the subsidiaries. Thus, there is a definitional change in the past items where the reinvested earnings used to be excluded from the estimation of the FDIs in India. However, in June 2003, the government have aligned that the methodology of compilation of the FDIs with the international best practices, and the India now follows the internationally accepted definition of the FDIs. Thus, the evaluation of the new policies, which was being done earlier also, the important sectors or the industries of the investment. One important criticism of the liberalization of the foreign investment has been to the investment which was take place in the non-priority sectors. However, the lion's share of the foreign investment in India since the liberalization has gone to the priority sectors. Now, several of the priority industries, including the infrastructure sectors, which were earlier excluded, reserved for the public sector, is open to the foreign investments. From January 1991 to September 2006, the following sectors accounted for nearly 60% of the FDIs, which include electrical equipments, including the computer, software, electronics, telecommunication, energy, transportation, service sector, chemicals, and other fertilizers. The drug and the pharmaceutical, food processing, and the metallurgical industries. These sectors attract the largest share of the FDI flows. The regional dispersion, the inward FDIs are highly concentrated into the few areas. The two regions like Delhi, consisting of the Delhi part of the UP and Haryana, and Mumbai, consisting of the Maharashtra, Dadar and Nagar Haveli, Daman and Diu, attract the large share of the FDI flows to the India. Karnataka, Tamil Nadu, Pondicherry, and Andhra Pradesh also receives large FDIs. The sources of FDI to India. The country-wise, the Mauritius and UK are the major FDI investors in India. Large flow from the Mauritius could be attributed as could be the use of investors in other countries for channelizing the FDI flows to India. Other important sources of the FDI to the India are US, Netherlands, Singapore, France, Japan, Switzerland, and South Korea. The foreign investment by the Indian companies in 1991, the Indian companies made a very little investment abroad. Although the government of Indian policy have been the encouraging foreign investments by the Indian companies, the subject to the certain conditions. Thus, the several factors like the domestic economic policies and the domestic economic situations were deterrent to the foreign investments by the Indian companies. By restricting the areas of the operation and the growth, the government policy seriously constrained the potential of the Indian companies to make the foray into the foreign countries through the investment. Added to this and was the attraction of the protected domestic market, which was in many cases a seller's market, and this made the Indian companies to ignore the foreign market. Thus, the Indian companies have established a subsidiaries and a joint venture in a number of countries in different manufacturing industries and the service sectors. Thus, at the end, we can summarize that encouraged by the favorable business environment fostering to the global liberalization, the economic private capital flows, which have been increasingly rapidly the cross-border mergers and acquisitions, has been a major drive in this recent surge in the FDIs, and the foreign capital are now contribute to the significant share of the domestic investments, employment generation, industrial production, export in the number of economies, including China. And thus, we can define two types of foreign investment. The first is FDI, that is the foreign direct investment, where the investors has a control over participation in the management of the firm. Second is the portfolio investment, where the investors have only a sort of property interest in the investing the capital in buying the equities, bonds, and other security abroad. And in case of the portfolio investment, the investor uses capital in order to get the return on it, but it has no much control over the use of the capital. Thus, the major portfolio investment in the Indian capital market is by the foreign institutional investors, that is FIIs. So, this is all about this part. Thank you, students. This is your faculty and coach and mentor for the subject business environment, Vivek Burda. For any queries, for any doubt of any issues, you can connect back to us on email ID vivekb.management@tmu.ac.in. We wish you a happy studies and good luck for your future.